Good afternoon, everyone. Thanks for joining us for this webinar. We're going to be talking today about things you didn't know you needed to know about both your investment portfolio and estate planning. We appreciate you being here. My name is Andrew Hall. I'm the Vice President of Narwhal Capital Management. I've got a colleague, Melissa Visible, with me, as well as Amanda. And Amanda is going to be opening us up today talking about estate planning. So I will turn it over to her and let her introduce herself and her content. Thanks.
Thank you so much, Andrew. I appreciate all y'all's help with this. I've never hosted a webinar before, so I'm excited to be here. And I know a lot of my folks are on here and a lot of folks that have never met me before. So I appreciate y'all taking the time, and I hope you get a lot of good stuff out of today. I've jam-packed my presentation full of tons of things you didn't know you needed to know and tons of decisions you didn't know that you even needed to make. And so I'm excited to share that with you today. So just some housekeeping real quick. We do have a Q&A session at the end. I'm gonna speak for about 30 minutes. Maybe if there's time in my 30 minutes to go ahead and ask some questions, I can answer some of those during my time. And then Andrew and Melissa will speak after that. And then at 5 or around there, we'll do another Q&A session if other people have questions that we can answer. So to ask a question, if you've never used this software before, you should see a little tab that says Q&A. And when you click on that, it should give you the option to type in a question. And then that should send it to me, and I can kind of help navigate those questions. You can ask it anonymously or not, either way. A second way is to raise your hand. Now, if you do it that way, when you raise your hand and I click on you, you will actually be on camera if your camera is on, and everyone in the webinar will be able to hear you. So if you're not into that, that's fine. Just use the typed Q&A instead. And last, of course, questions to the whole group really should be broader questions. If there's something very specific to your situation that you want to ask, the three of us are completely open to you emailing us directly, and we can answer those questions that way if it's something more specific than you really want us to answer in front of everybody. So with that, I'm going to get started, make sure I remember how to do this. If I remember how to move my PowerPoint. Okay, there we go. All right, so I'm focusing my presentation today on the very bare minimum estate planning that everyone needs to do no matter what. This is the bare minimum. There's lots of things and lots of bells and whistles that you can add on top of this to help avoid probate and some other things that I'll mention to you today. But I at least want everybody, and I want to shout it from the rooftops, I want everyone to know you got to at least have these three things and what to look for and what types of decisions you'll be making and why it's even important. So the first one, of course, the first document that everybody needs, there's three documents that everybody needs. The first one is going to be your last will and testament. The second is going to be your Georgia financial power of attorney. And the third is going to be your Georgia Advanced Directive for Healthcare. So I'm going to go through all three of those today. All right, so let's start with the will. A lot of folks generally know what a will is. It says who inherits from you and all of that. But why is that important? One thing you may not realize is if you don't say who inherits from you, the law says who inherits from you. And it may not be who you think it is. This is one big myth in estate planning. A lot of people assume that if they're married and they have children, that their spouse still inherits everything from them. And that's not the case. The first level of inheritance, if you don't have a will, is spouse and children. And spouse could end up with only a third, and children could end up with 2/3. Now, why is this important? Well, for example, let's say you own your home jointly with your spouse. Here's myth number 2. Just because you own a piece of real estate jointly with your spouse does not necessarily mean if you pass away, the spouse automatically inherits the other half. There is a way to do that. It's right on the deed if you have that type of deed, but you may not have that type of deed. So if you don't know, look at your deed, send it to me. I'll tell you which one you have if you're just not sure how to read it. But I can't tell you how many probate clients that I get that end up owning their house with their 2-year-old because they didn't realize that they weren't going to automatically inherit the home. And so it's very important that you choose who inherits from you. And if you want it to just be spouse, then you got to say that in your will. You also do things in here like nominate your choice for executor. You want to have a say in who's going to be in charge of your estate, right? You want to choose the person that you're going to rely on to do that. And then those folks with minor children, you definitely want to have a say in who's going to be their guardian. Definitely not something pleasant to think about. You don't want to think about it, but you have to. And you both need to be on the same page about that if you can. Okay. And now that I'm kind of jumping right in, I realize I didn't tell y'all much about me. I know some of y'all already know me, so I'll kind of backtrack a minute. So I'm Amanda Riedling, and I've been practicing law for coming up on 10 years now. I'm older than I look, but I've done nothing but this area of law the entire time. I'm one of two owners of the Georgia Wills Trust and Probate firm in Marietta, where I could see the courthouse outside my window here on Marietta Square. And we do obviously estate planning for people, from basic planning to probate avoidance to tax planning, various different types of trusts and all those sorts of things. We also do the probate side, where we're helping people implement the documents. So we actually know how they work and what happens in the probate court and all of that. So doing one really helps us be good at the other. And I think that makes us special, so because a lot of firms only do one or the other. And then the last thing we do is adult guardianship and conservatorship. And that's where you have an adult who has lost their capacity and maybe the power of attorney needs to be used now. And we help the family navigate that and help take care of their loved one. So sorry, I forgot to go through that for myself. I got all excited. So back to the will. At a minimum, these are the things that you want to have in your will. So again, this is the very, very basic. So of course, you always want to make sure that the person signing their will has capacity, right? They need to be over the age of 14. They can't be under any undue influence. Of course, they need to sign it. I mean, I put kind of your basic things that make it valid. It needs to be witnessed by two disinterested witnesses. Something else you may not have known that you needed to know is it's not enough just to sign it and have the witnesses. In order for it to be what's called self-proving, meaning it makes probate a lot easier and cheaper, you need to have a self-proving affidavit on the back. Now, it has very specific language of what needs to be in there, so don't try to do this on your own. It does require a notary for that part of it. But by adding that to your will, you really are making the probate process a lot easier for your family. So a lot of people don't realize if you have to probate a will and you don't have that affidavit, your family has to actually go find the witnesses to the will. They have to go find them and get them to do the affidavit then. And I've helped probate wills from the 70s, okay? So I've had to try, and the court makes you try. They actually make you try to go find them and prove that you tried to find them if you couldn't. So it does make that process more difficult for your family if you don't have this. So definitely want that at a bare minimum. Everyone has to be in the same room when you sign. I won't get into the boring details of it, but it's not a good idea to do any remote signing. Those could be challenged in court as not valid. So you definitely want to be in person when you're signing it. Of course, you want to date it. All right, another thing you didn't know you needed to know right here where it says waives requirement for bond inventory returns and reports. Most people I find don't realize that if you don't have a will that waives these terms here in the body of the will, your executor or whoever manages your estate has to, one, post a bond, which is an insurance policy that they have to pay for that protects your estate from them, right? So it makes probate more expensive. The second thing that they have to do is file an inventory of every asset you own with the probate court. Bank account numbers, amounts to the penny, a list of all your real estate and values. And guess what? It becomes public record. So you want a will that says, I don't want my executor to have to do that. So if you never have a will, whoever manages your estate is going to have to do that. It's very invasive. Returns. A return is literally a checkbook analysis of every single penny your executor spends in your estate and for what. And it's the same thing. It's filed with a probate court. It's public record. It goes online. Everybody can see it. So for no other reason to have a will, it's to waive those requirements right there. Of course, you want to name an executor, a guardian. We already talked about that. One thing I see, you see this residue clause mentioned down here. A residue clause is like a catch-all of, I give everything else that I haven't specifically mentioned to X person. You don't want competing residue clauses because it creates ambiguous provisions. That's what creates litigation in your family, because nobody really knows what you meant and who you wanted to leave it to if you have two provisions saying the same thing. And I will tell you, a lot of what is it, Legal Zoom, or what, I forget now the name of it. And there's also, you can buy forms and things like that at stores. A lot of times they'll have those in there because they don't know any better and they're not state specific. So that's one thing you want to check. Make sure there's only one residue clause and there's no conflicting or ambiguous provisions. So again, I strongly encourage you not to draft your will on your own. People do, but that's the reasons why. Okay, some other good things to have. You want to make sure that the assets you're giving away in your will actually pass under your will. So there's things called non-probate assets. These include joint bank accounts, beneficiary designations. All of those things are tools to help pass assets outside your will to your loved ones. But if you put in your will who you want to inherit that, but the joint owner or the beneficiary is someone different, the will is not going to govern at that point. So just make sure that if you have assets that you have strong feelings about who inherits them, make sure they're the right beneficiary, or make sure that asset doesn't have a beneficiary so it can pass under your will. Another thing that you want your will to do is to address years support. I don't have time today to go in full detail about what that is, but it's a benefit to spouses and minor children if there's a lot of creditors of an estate. Your basic forms aren't going to do that. It's very state specific, so just something to be aware of. I always recommend having backup nominations for each role, your executor, your guardian, everybody. Name a primary, but also plan for contingencies. What if that person passes before me, or what if they don't want to do it? Go ahead and name as many backups as you want so you can plan for those contingencies. So then we get to the doomsday provision. This is actually a legal term, the doomsday provision. What if everybody's gone? You want to have a catch-all at the end for if everybody I've mentioned is gone, have a formula for who inherits from you then. Because if you don't, it reverts back to those laws I told you about, where the government decides who inherits from you through they're called intestate laws. You don't need to remember the term, but that's what they are. So you could pick a charity, you could pick a class of person, so nieces, nephews, grandchildren, all of them. Okay, so I'm going to give you a little teaser. We're not going to have time to go into this today, but a lot of people don't realize that even though you put a will together, if you pass away, your executor does not automatically have authority to do anything. They first have to file your will with the probate court and get a court order stating that they can do things. So they can't immediately go get in your bank account. They can't immediately list your property for sale. They can't get any information at all. So if you're interested in talking about how to avoid probate, we don't charge for estate planning consultations, so you can call us. It don't cost you anything to just sit down with me privately and learn how to do that in your specific situation. It's a little teaser there. All right, so the second document that everyone needs, no matter what, is your Georgia Financial Power of Attorney. So fun fact about this, you'll see over here to the left, is forms that are out-of-state forms. So let's say you've moved here from California or something, or forms that you may have used before 2017 are not required to be honored in the state of Georgia. That doesn't mean they won't be, but they're not required to be. It's up to each financial institution. It's up to each person that you're trying to do business with under a power of attorney. So a Georgia financial power of attorney, this is where you name someone to manage your finances for you and your assets if you become unable to do so for yourself. You also decide how much power they're going to have and what rules they need to abide by. So it's very, very important. The reason is a lot of people don't realize, again, something you didn't know you needed to know, what does happen if you end up in a coma in the hospital and somebody needs to get in your bank account and pay your bill? What ends up happening is your family or whoever's going to step up and care for you has to actually have you deemed incompetent by a court. It's a very expensive process. It's a very lengthy process. It's a very invasive process. It's called guardianship and conservatorship if you're interested in doing some research on that. But that's your only option outside of just doing a very, very cost-effective power of attorney. You're going to pay a few $100 for that, and it will save your family lots of time, energy, and thousands, if not tens of thousands of dollars down the line. So the bare minimum that you need to consider and think about for your financial power of attorney is some of the same things for the will. So you want to make sure that whoever's signing it, whether it's you or if you're helping a loved one with it, make sure they have the legal capacity to do it. Obviously, they have to sign it. This one has, in Georgia, needs at least one witness. I recommend two because some other states require two. So you might as well go and do two in the off chance that you need to use it in another state. It does need to be notarized. And then you still have that line of sight test, so you need to all be in the same room when you're signing. Of course, you, excuse me, you want to nominate your financial agent. Who's going to do these things for you? Who do you trust to do these things for you? Some considerations are, do they live close by or far away? It's perfectly fine if your agent lives in another state. It does make it a little bit more difficult logistically, but there's no reason legally that they can't do it. Another thing you want to do in this document is nominate a conservator for you. So again, that's the process where you unfortunately need to, for whatever reason, be deemed incompetent by a court. That person's called a conservator. You always want to nominate someone to do that if a court ever has to get involved. And I know you're thinking, well, if I do the power of attorney, why would the court ever have to get involved? In the rare circumstance that you become a danger to yourself or others and you need to be protected from yourself, or if someone, an outside party, is taking advantage of you or abusing you, the courts do have to get involved in that case, and you still have to go through that conservatorship process. So in your power of attorney, you want to nominate and tell the court ahead of time, here's, if I ever need that, here's who's going to do that for me. All right, so another thing on the Georgia form that you'll do is there's going to be all sorts of blanks where you'll initial all the things that you want your agent to do for you. Definitely have an attorney help you through that because some of them are not very intuitive. I help lots of folks talk through what all the powers mean and the pros and cons of giving the power versus not. So there's a lot of benefit in that. Okay, so outside of the bare minimums for your power of attorney, again, you want to always have, this is my recommendation, it's not required by law, have a backup plan for those contingencies. If my first agent that I've named can't do it, doesn't want to do it, if they pass before you, who's going to be my backup? One thing you want to consider is giving the power to create a trust and transfer property to a trust for you. That is not appropriate for everyone. It's just something to think about. Trusts can be used as probate avoidance tools. That's what we help many, many people do. I've done that plan for myself. Another thing you can do is add an information sheet to give guidance to your agent about where to find things. Because if they're not already helping you with your assets, how are they going to know who to call? How are they going to know who your mortgage company is? How are they going to know where you do your banking? you want to give your not just your agent, but also your executor, a roadmap of how to find your stuff and how to take care of you best. Okay. Another thing you want to analyze is whether you want the power of that person, that agent, to go do things for you. Do you want that power to be effective as soon as you sign the document? Or would you rather them only use it if a doctor has actually said that you're incapacitated and you need someone to do that for you? Okay. It requires special drafting if you want to have it effective some other time. But it is a decision that you might not have realized that you needed to think about and make. Last, you want to analyze whether you want some checks and balances, because I have no evidence of this. This is just my perception that powers of attorney are the most abused document on the planet, in my opinion. And it's a lot of power to give someone, because by definition, if you're using a power of attorney for someone, that other person is probably not aware of what's going on. And so, you can have reporting requirements in your power of attorney to say, okay, if this person is using this for me, they need to be reporting and letting this other person know at least once a year how they're taking care of me. That way, if there are some mistakes being made, or maybe you're not being cared for the way you are supposed to, someone will find out about it and be able to step in. You also want to say what types of reports that you want them to give, so you have the control. So this is part of that. You decide what rules they need to abide by. And last but not least, let me check my time, we're still good, is your Georgia Advanced Directive for Healthcare. Now, the reason you, on this one, also want to use a state-specific form is because the doctors that you're going to go to here in Georgia are trained to interpret the Georgia form. It hasn't changed for many, many years. Every doctor you've gone to, they're trained on this one. If you bring a form from another state, or if you use some form that is not the state form, you risk the doctor misinterpreting it, or if the doctor truly doesn't understand it, they may require you to go get a court, or your family to go get a court order to take care of you. So it is advisable, if you don't have the Georgia form, to switch to it. So your Georgia Advanced Directive for Healthcare is actually two things in one. It is a healthcare power of attorney, which is where you name someone to make your medical decisions for you if you can't do so for yourself. It also gives guidance about your wishes. That is the living will portion. So it's a healthcare power of attorney and a living will all in one document. It only requires 2 witnesses. It does not require a notary. It's a lot easier to do than some of these others for that reason. But you want to give your agent guidance about, how do you feel about organ donation? Do you prefer burial or cremation? How do you feel about end of life decisions and life support, those kind of things? Nothing anybody wants to think about, but it truly is a gift to your family to give them guidance of what you would want in that scenario. So again, at a minimum, you of course have to have legal capacity. The person doing it has to sign it, 2 witnesses. We already talked about that. I think I've already addressed all of these. Other good things to have in your advanced directive is, again, backup agents. In this one, you nominate a guardian to serve if a court ever needs to get appointed for you. So the term conservator is over money, and the term guardian is over the person and their medical decisions. But it's still the same court process. You want to go through an initial certain blank saying what your wishes are. The document is not intuitive. In some places, you initial things you do want, and in some places, you initial things you don't want. It's very easy to get your initials in the wrong spot, so having the help of an attorney is beneficial for that. We already talked about that. Okay, so just some other takeaways, and then I do see a couple questions that maybe I can get to before the 4:30 time. Don't wait until it's critical to have the documents. Don't wait until you're going in for a procedure, or you get a no one knows when they're going to get a diagnosis of anything, but still, don't wait. Do it now while you have a clear mind. You're not under any stress. You're not under any trauma. One, it's more expensive. Lots of firms, including ours, we do charge a rush fee if you need a quick turnaround time in a matter of a few days or a week. The reason is because we'll have to cancel appointments and cancel other people to move them back to make time for you. And so it is more expensive usually if you wait. It's more stressful. And you want to make all of these decisions when you have time to really process it and you're not under pressure. Don't draft them on your own. Legally, you can draft your own documents. However, you cannot legally draft other people's documents, including a spouse or a child or a parent. You legally cannot draft someone else's documents unless you are a licensed attorney to practice law in Georgia. It's a misdemeanor if you do that, and they do actually prosecute it. I've seen it. There's a whole group of folks that police that. So be very careful if you're helping someone else. Keep in mind, if you pass away or you lose your capacity, it's too late to correct documents if they're not done well. That's another benefit of having an attorney help you. Let's see. I think I hit on all those things. So let me see. I've got a few minutes to go ahead and maybe get a couple questions here. So someone asks, if I have a simple will and inherited by a minor, does he still need to go to probate? I may not fully understand the question, but generally, if you have a will and you have assets that pass under that will, yes, your estate will have to go to probate, even if your beneficiaries are minors. Minors cannot serve as executors, but probate is still required regardless of who the beneficiary is, whether it's a minor or not. So yes, by having a will and having assets that pass under a will, that does require probate. This reminds me to caution you. I do not recommend naming minors as beneficiaries of any bank accounts, life insurance policies, IRAs, 401ks, nothing. Minors can only inherit up to $15,000 before the court requires a conservator for the minor. And I already talked about that, how that's very expensive. You have to be bonded, you have to file reports, all of that. So if you have minors and you want to avoid probate, I'm definitely happy to talk to you about tools for doing that. But naming the minor as a beneficiary of something is not usually preferable. It's fine if, again, it's your preference. It's fine if you're okay with the conservatorship, but lots of people don't realize that that's what happens if you have a minor inherit a bunch of money. The next question says, do witnesses have to be available when executing the will? Yeah, if I'm understanding this question correctly, they have to be there. I mean, witnesses have to be there watching you sign the will. So yes, they have to be available when you're signing the will. If I misunderstand a question, anybody just email me or set up a time to talk, and I'm happy to answer that. I got 2 more minutes here. So someone else asked, will we be sending out a copy of the slides? Yes. After we're done, the webinar gives us a list of emails. I'm going to email you not only this presentation, but also Andrew and Melissa's. And then someone asked whether the Zoom is being recorded. I told it to record. Technology and I do not always get along. So if anybody wants the recording, Andrew, Melissa, tell me if you have any objection to it. But if anybody wants the recording, as long as it worked, I don't have any objection to sending it. So, all right, one more question here. Can you add guardians and conservators after the will is made? Yes, all of these documents are completely amendable. They're completely revocable. As long as you are here and you have capacity to do so, you can completely undo them. You can make changes. You can just change this person's name or that person's name. There are formalities that you have to use before you do that. You can't just mark their name out and write somebody else's name. That is not effective. You have to follow the same exact formalities to change it as you did to create it. So if it required 2 witnesses, the change requires 2 witnesses. If it required a notary, the change requires a notary. So these are great questions. I appreciate that. All right. So that's it. So I'm going to turn it over to Andrew. And Andrew, since I'm the host, if you break for questions, I can kind of help do questions at that point for you. So have at it.
Thank you, Amanda. We appreciate it. I'm going to get my presentation up here and we will get going. I really appreciate that content. I think it was very helpful, hopefully, to everybody here. I know I learned a lot. And my hope is that as we look at the big picture on investments and investment portfolios, that similar to what Amanda just presented, you'll realize there may be some things you haven't really thought about before. Quick disclosure, I'm not going to read this whole thing, but you will get a copy of this presentation, as Amanda mentioned, so you can dig into it. I do note that there's a number of our clients here for this presentation. We certainly appreciate you being here. Some of this may sound like old hat, things you've heard before, and if that is the case, grab a glass of wine or a beer and come back for the Q&A if you got anything you want to throw into the ring. But a little background on our firm, similar to Amanda, we're very close to Marietta Square. We're actually, I can see Kennestone Hospital out my window, so maybe not quite as pleasant of a view, although the hospital versus courthouse might be a toss-up. For our firm, there's really three things that we strive to deliver for our clients. The first is investment performance. We want to be competitive with benchmarks, but really build customized portfolios that make sense for each client. We put a big emphasis on service and education, which really is what this webinar is all about, getting an opportunity to talk to folks about things that we think are important, things that we think you should be mindful of. So with that out of the way, we're going to jump in. And as we talk about investing, if you take nothing away from this presentation, I want it to be this: investing is not a pass-fail system. Far too often, we talk to people, whether it's potential clients, existing clients, people that just know what we do for a living, and we hear something along the lines of, well, my portfolio is worth more than it was a year ago, so I guess it was a good year, or my stocks are up, I guess I'm doing pretty well. And what I would argue is that that's not a very accurate assessment of the health of a portfolio. There's a lot of confusion, and a lot of that, frankly, is our fault as people that work in the financial services industry. We are not an industry that is very big on transparency. We're an industry that really likes to historically focus on sales. We want to get more clients. We want to get new clients. And we really want to drive revenues for our own firms by racking up more accounts, more so than racking up great performance or appropriate investments. So for us, I think as an industry, we've put way too big of an emphasis on sales. And we've been able to give ourselves a cop-out by simply training people to think that if the portfolio is up, we as professionals have done our job well. And the reality is that's not the case. In 40 of the last 50 years, the S&P 500 has generated a positive return. So if that's the standard of success for our industry, we're going to win more often than we lose by a pretty significant margin. 4 out of 5 times, if our clients think having more money than they had a year ago was a win, we're going to be able to show them a path to victory. And I would argue that that's not a complete picture of the health of an investment portfolio. So to see that big picture, we're going to look at 4 things. I wrote a blog post about this. We'll share information about our blog a while back. And this is really rooted in how we review our portfolios, not only internally, but also if we ever have someone that comes through the door and wants us to take a look at their existing investments and give them analysis on how it's performing. And when we do that, we look at these 4 things, and we're going to really focus on these along the way. We look at asset allocation, benchmarks, taxes, and fees. So the presentation keeps getting better. We've already talked about death. Now we're going to talk about taxes in a few minutes, but just bear with us. Hopefully this is helpful. Along the way, we're going to look at a sample statement. So you can see to the right of your screen, a sample Charles Schwab statement. This is a fake account. The numbers aren't real. The people aren't real. But I think it's helpful sometimes because people get very overwhelmed by brokerage statements. You can see this is the first page of a 31-page brokerage statement. It's very hard to find the actual information that you may want or may need. So where applicable, we're going to kind of highlight where you could find some of this information. So starting off, I want to talk about asset allocation. Ultimately, asset allocation is just the fancy industry jargon for saying how much of your portfolio is in stocks, how much is in bonds, how much is in cash, how much is in precious metals, how much is in real estate, all these different ways that you can be invested. How are they weighted? And it usually shows up on a statement, as I'll show you in a minute, as a pie chart. That may be one of the few things that people can consistently find on a statement, is that weird pie chart on the front that seems important because it's at the beginning. But for us, when we think about asset allocation, I really want to encourage you to be thinking about things and 3 priorities specifically. Number 1, is it intentional? What I mean by that is your asset allocation should be reflecting your risk tolerance as well as what you want to accomplish with your investments. So is there a reason behind it? Secondly, is it consistent? When you open the account, you probably talked to somebody, if somebody's managing your investments for you, and they probably laid out a plan and they said, hey, you know what? We're going to have you at 60% stocks and 35% bonds and 5% cash. Are they still maintaining that? Because if it made sense at the beginning relative to your risk tolerance and your investment objectives, and nothing has changed on those 2 fronts, why would your asset allocation deviate? And thirdly, is it clear? Can you clearly determine how your portfolio is actually positioned? So here's an example of a sample statement, as I mentioned, and you can kind of see right here that asset composition. It lists cash and money market funds. It lists fixed income, which is bonds, equities, which is stocks. It breaks out bond funds, equity funds, all of those things, and puts a nice, pretty picture in terms of how you're actually allocated. When you're thinking about asset allocation, these are the things I really want you to be looking for. Number 1, do you know what your asset allocation is? Even just in theory, do you know how you think your portfolio is positioned? Secondly, do you know why you're positioned in such a way? And thirdly, do you agree with that? Given your age, your risk tolerance, your income needs, your ability to take on risk, all of these things, does the allocation make sense relative to what you think it should be? Fourthly, as I said earlier, is your allocation consistent? And this is a big one. You don't want an asset allocation that just looks really, really close and really, really appropriate to targets at the end of the year. You want an allocation that you could look at any point in the middle of a month and say, wow, this is exactly what I thought it should be. And if it's not consistent, what is driving those allocation changes? We're going to see a similar slide to this as we talk through the other factors of analyzing a well-balanced portfolio. The biggest thing I would encourage you to do, if you're not pleased with the answers to these questions, talk to your advisor. They may be doing things exactly right, but you don't really know why they're doing it. It's a great opportunity to engage with them and learn a little bit more. If you're not sure what types of questions to ask, start casually. Hey, can you refresh me on why my portfolio is allocated this way? If you see things start to change over time, ask the question, hey, I see I own a lot more in stocks than I did a year ago. Is that intentional? Should we rebalance? What's going on there? If you see a whole lot of cash in the portfolio, ask why there's more cash than there used to be. Is that part of a strategy that's being deployed, or is somebody asleep at the wheel? Really ask these questions and try to get them to engage with you so that you can better understand what's going on in your portfolio. Secondly, we want to talk about benchmarks. So I mentioned earlier that the S&P 500 is typically up. Most of the time it is up. At the end of the day, that's why people invest. That's why investment advisors like ourselves have jobs. People want to do something that is going to increase their wealth. They want the market to be up. They expect it to be up because frankly, it usually is. So if the market's usually up, it becomes a little bit more difficult to figure out what a good year is. What actually was good performance. You need to be looking for appropriate benchmarks relative to your asset allocation. So benchmark is just a fancy way of thinking about how did a broader market do? We have a lot of clients that ask, hey, how's the market doing? Sometimes they mean, how's the Dow doing? The Dow Jones Industrial Average. Sometimes they mean the S&P 500. Every once in a while, they mean, the global world of, publicly traded equities. There's different measures of what the quote unquote market is doing. But there needs to be one that's consistently relied upon to gauge the health of your portfolio. There are also benchmarks, not just for stocks, but also for bonds. And I've listed a couple here. But you need to be looking for appropriate benchmarks. And this creates a challenge. I mentioned a few minutes ago that our industry is not real big on transparency. We like to kind of hide things and confuse things. So here's really what I think is the benchmarking challenge. First and foremost, Brokerages, whether it's Schwab, who we work with, Fidelity, Raymond James, Merrill Lynch, Morgan Stanley, you name them, they don't always define the most appropriate benchmark. Sometimes they don't list much at all. Advisors often will just show raw benchmarks, but if I'm just showing you how the S&P 500 did, which is going to measure the performance of stocks, large stocks here in the US, and half your portfolio is invested in something other than large US stocks, I'm not really helping you to gauge how you're performing. You really need to be comparing to an appropriate benchmark, and that becomes difficult. I would encourage you to lean on your advisor to define this for you. Let them do the legwork. We have clients that ask us for customized weighted benchmarks all the time. We're happy to do it. But you really may have to do some legwork. You may need to look up benchmarks to see what's the most appropriate benchmark for how you're invested, even on the equity side. And you really want to look at each asset class. One thing we try to show all our clients at the end of every quarter when we send out our reports, which are different than maybe the Schwab reports, is we try to say, here's how your stocks did. Here's how your stock benchmark did. Here's how your bonds did. Here's how your bond benchmark performed. And you can use those numbers to kind of calculate a customized weighted benchmark to really see how you're performing. For this, I kind of used an example. As I mentioned, it's hard to find benchmark data sometimes on brokerage statements, but this is a real world example. Melissa, who's speaking in a little while, she kind of saw it play out. But we spoke with somebody recently, this calendar year, who was very excited, was pleased with his portfolio. He was managing it himself. And it was up about 10% in 2020. Now, if you go back a year ago, last March, when the market's just cratering, everything's falling apart, you probably would have loved to know that your portfolio was up 10% by the end of the year. So he was very excited. He was up 10%. When we looked at it, 75% of his portfolio was invested in large US stocks, and 25% was invested in US based corporate bonds. So he was 75% stock, 25% bonds. As it turns out, being up 10% was not the big victory that he really thought it was. The S&P 500 was up 18.4% last year. The bond index that was most appropriate for the corporate bonds he owned was up 5.21%. So if we weight those returns and we take 75% of the S&P 500 and 25% of the bond index, his true benchmark was actually up 15%. But that's an exercise that most people aren't willing to do. So if you take away nothing else on the benchmarking section, it's do some homework. Again, try to make your advisor do it for you. You're paying them for something, right? Let them do that for you. But if they aren't willing to do that for some reason, look into it yourself and find what the most appropriate benchmark is. So questions to be thinking about: what's an appropriate benchmark for each asset class? Again, it's great to know how your stocks are doing versus stocks, how your bonds are doing versus bonds, et cetera. Can you find that data? Can your advisor give it to you? Figure out a way to make that happen. Thirdly, do my benchmarks stay consistent with my investment strategy? Along the lines of just the chaos that financial services try to create is really this theme where we see people change their benchmarks all the time. If your benchmark that you're being shown by an advisor or a robo-advisor or a platform changes, you need to be asking why it changed. Because if you're still invested the same way, the measuring stick by which you're measuring your performance should be exactly the same. So questions you can be asking: hey, why do you use this particular benchmark? Can you show me a blended benchmark that reflects my asset allocation? And that's really why we led with asset allocation, because that matters. Hey, why did my benchmark change? Does that mean my investments change, or has the strategy changed? So these are some great questions to be thinking about. If we can help in any way analyzing this stuff, we're happy to help. We do this a lot for people. It's pretty easy to go through, and we'd be happy to just give you kind of a free look at how your benchmark's actually performing. Taxes. Everybody loves to talk about taxes. Investments by nature generate taxable events. You need to be aware of that. You need to recognize that. Taxes are not, in this instance, inherently a bad thing. If we can break the mold of realizing that taxes are bad, but they're a byproduct of portfolio growth, we can start to stomach writing those checks a little bit more easily. But you need to be aware of how transactions are taxed. I mentioned that we're going to send this out to people. I think this will be a great slide to actually look at. There's a lot of data on some of this stuff. But when we talk about taxes, we're really looking at two areas. First, as you can see highlighted here, dividends and interest. Secondly, capital gains. And there's really two classifications of capital gains. When we think about capital gains, I've got data here both for single filers and joint filers, and I'm not going to go through this line by line, as fun as that would be. You essentially have long-term capital gains, which are capital gains from when you buy a stock or a bond or a mutual fund and you sell it after holding it for a long-term period, so over a year. And then you have short-term capital gains. At the end of the day, the biggest takeaway from this is short-term capital gains are consistently taxed at a higher rate. Long-term capital gains are going to be at a lower rate. When you think about short-term capital gains, they're really going to be taxed at your marginal tax bracket. So whatever you're paying on your actual income. And on long-term, you can kind of see these 0, 15, and 20% brackets. Again, we'll send this out. You can review it. You can take a look at it. So when you're thinking about taxes, the big questions I think you need to be analyzing is, as a percentage of my total portfolio value, how much is my realized gain annually? I really want to focus on realized gains. Again, dividends, those are a distribution of profits from profitable companies. Those are to an extent unavoidable and usually a sign of financial strength from whatever company you've invested in. I'm not as worried about those, but on the realized gain portion, you really need to be thinking about how much am I actually realizing in gains every year? Here at Narwhal, we manage portfolios primarily by owning individual stocks and individual bonds. The reason we do that, or at least a reason we do that, is so that we can be much more agile on the tax side. It sounds crazy, but in 2019, the S&P 500 was up more than 31%. We had a lot of clients whose stocks were up more than 31% and actually had realized losses inside of their portfolio. You know, as a firm, we try to make sure that realized gains over the long term are under 2% of the total portfolio value. We really try to be aggressive with that, ideally netting it out to zero and possibly even a loss. So ask your portfolio manager what he or she is doing to actively limit capital gains. Do you have agility in the portfolio? And on agility, again, a big reason why we use individual stocks and individual bonds is that when we have a client that has a cash need, almost all of the time, we're able to raise cash for them without a huge tax hit. If we only own one mutual fund or we only own one ETF and they've held it for a while, there's going to be an embedded gain no matter what. So these are good questions to be asking, especially if you start to see spikes when you're looking at your 1099 at tax season. You know, ask, hey, why are my gains so much higher this year than last year? What was going on? Did we shake things up in the portfolio? Did you think about the tax consequences? Even be proactive enough to say, hey, I'm not questioning your judgment on this investment, but I see it's down right now. Does it make sense to sell it and actually harvest a loss in order to offset some potential gains elsewhere? Lastly is fees. Fees are, usually the first question we get from potential clients. People want to know about the fees. I put it last for this reason. If your asset allocation makes sense, if your performance relative to appropriate benchmarks makes sense, if your tax burden is appropriate, the fees tend to work themselves out. I'm not terribly worried about it. You know, somebody might offer a product for a lower fee, but if they can't generate consistent returns on a tax efficient basis on an appropriately allocated portfolio, they're not doing you any favors just by saving you money on fees. But you do need to understand your total cost of investing. And that's not just what you're paying your advisor. That's going to include account fees, commissions on trades, and even expense ratios inside of products. So to look at that, we've got kind of an example here of two hypothetical clients. So both of them have $1 million in their portfolio. One of them has an advisor charging 1%. One advisor is charging 0.75%. Client one is paying an account fee to their custodian of $100 a year. Client two is paying $0 a year. Neither of them are paying any commissions on their trades. Client one owns 30 individual stocks and 15 individual bonds, and client two owns 4 mutual funds at $250,000 a piece. And I just pulled these mutual funds at random. They're very commonly held inside of 401ks and things like that. So the question is, who pays more? Well, if we look at client one, who's paying the larger advisor fee and also paying an account fee, we can see here that they're paying $10,000 to the advisor, $100 in account fees, a total cost of $10,100, which relative to the total portfolio value is 1.01%. So what about client two? They're paying less to the advisor, which at surface level is a win. They're not paying an account fee, and that's a good thing. But those mutual funds that they have $250,000 a piece in have embedded expense ratios. And they don't notice those. People rarely know what their expense ratio is inside of mutual funds or ETFs. And the reason is it's one of the few fees in life that you don't write a check for and you don't see show up anywhere on an account statement. It's just pulled out of the value of that fund. It's very under the radar. I'm not saying it's inherently a bad thing, but it is something that people usually aren't aware of. So client two is actually paying 1.26%. So they're actually paying more in total fees, even though their advisory fee is a little bit lower. So when you're looking at fees, things to think about, try to define your true cost of investing and try to ascertain if that makes sense relative to your portfolio size. In general, in our industry, we've gotten a little bit better at fees. There's a lot more competition, not only among different advisory practices, but also among technology platforms. That's a good thing for the average investor. But as your account grows in size, the general trend is that your percentage paid in fees should go down. Make sure that's happening. Are you paying an advisor a lot of money to have them turn around and pay mutual fund fees and ETF fees and other product fees? Who are you paying to do what? And if you're not pleased with those answers, again, talk to your advisor. Some questions you can ask, hey, I see this mutual fund here and I see that it's got a 1.5% expense ratio. Is there a different way that we can get that exposure with a smaller fee? Is there a way that we can reduce that? If you're still paying commissions on trades, talk to your advisor. Hey, is there a way that we could move to a different platform where I'm not still paying commissions? There's lots of platforms out there where you don't have to do that. Those are great questions to be asking. As we kind of wrap up, I hope you get now why I say that simply having a portfolio that goes up is not necessarily a win. In our view, a well-rounded portfolio has an asset allocation that's appropriate, that's understood by you, and that's consistent. It holds its own and beats appropriate benchmarks over the long term. Again, don't mishear me. Everybody's going to have days, weeks, months, quarters, and years where they underperform. What you really need to be looking at is kind of that 3 to 5 year window to see how performance is looking. Obviously, there's exceptions to that. Massive underperformance in any period can really be devastating and really set you back. But be thinking about the long term on this stuff. Are they generating tax bills that are understandable relative to the growth and are predictable? And is the portfolio free from unnecessary fees? With that, I'm going to turn it over to Melissa Bisbal. She is our financial planner here at the firm, and I'll let her introduce herself and talk through kind of some basic steps in terms of what to be thinking about as you're thinking about investments.
Awesome. And thank you for that introduction, Andrew. And thank you all for attending and hanging in there with us. Just a little bit of background on myself. I graduated from the University of Georgia with a bachelor's degree in consumer economics. And then I went on to grad school where I did financial planning. And then I came over to Narwhal in June 2018. And I started developing the financial planning department here, and I've been building comprehensive financial plans for our clients. If you have any questions, a little bit more about my background, definitely feel free to reach out. So often advisors and planners are asked, should I be saving more right now? Should I be paying down more debt? What should I be doing right now? And truthfully, the answer is usually, it depends. And this is pretty much the answer to every financial planning question I get. But this here on your screen, it serves as a workflow to make sure you're checking off some boxes. Some things to know is that this is after your essential expenses are covered. And there may be certain factors that influence doing one over the other, causing you to reprioritize this workflow. But to go ahead and start, the first one is establish emergency and rainy day funds. So you've probably heard about an emergency fund. It's used to help cover expenses if you were to have a serious illness or a job loss. And typically the benchmark is 3 to 6 months of living expenses. I say this depends on your number of income sources, your risk tolerance, and your ability to get a new job. I'd recommend about 3 months if you have 2 income sources and 6 months if you have 1 income source. And when we're talking about living expenses, we're talking about non-discretionary expenses. So expenses that you have to pay for. Think insurance premiums, your car payment, your mortgage, or your rent payment. And then rainy day funds are occasional time-sensitive large expenses. So you can think like a vet bill, a car repair, a home repair, or an unplanned travel. And this could be anywhere from a couple hundred to a couple thousand. The next step is contribute to a 401k that offers matching employer contributions. So we often say max to the match, at least do this. So this means you contribute the percentage of your salary it takes to get the match from your employer. And this is free money, so it's about as good as it gets. Definitely recommend doing this. If you have the cash flow to defer more and want to lower your tax liability, you could also consider deferring more. Now, the current administration is working on some legislation that could potentially alter this recommendation. The Biden tax plan proposes a credit cap versus a current full pre-tax deduction for a 401k contribution. So tax law changes like these is something we keep a very close eye on and we try to educate our clients on. Moving on to the next step, it's continue making minimum payments on outstanding debts, followed by making higher debt payments by either exceeding the minimum payment on high interest debt, or you can employ a snowball method. So this really depends on your view of debt attack. A lot of people have opinions on this. A lot of advisors have opinions on this. Ultimately, I think it's what makes you feel comfortable and what's going to make you successful in attacking that debt. Snowball method is attacking smaller amounts at first, then you take those amounts you were making to those smaller debt balances and apply it to the larger amounts of debt. I will say when you're analyzing your debt, you really need to consider your interest rate on that debt and the return on the market. A common example of this that I see is those who have large amounts of student loan debt, and I'm talking like double your salary. Some borrowers may have the opportunity to enroll in an income-based repayment plan. So this provides the borrower the opportunity to meet retirement goals and other funding goals. So it's not as simple as just recommending that you pay more than the minimum payment to get that debt out. That might not be the best solution for you. And so as a certified student loan professional, student loan planning is another service that we also provide. Moving on to the next step. So at first we established the emergency savings. Now we're gonna increase the emergency savings and just make sure it's funded at that 3 to 6 months of living expenses. The next one is contribute to a traditional or Roth IRA. So you can contribute up to $6,000 for this year. There's also a catch-up provision of $1,000 for those who are age 50 or above. So you can contribute up to $7,000 for those individuals. One of the main differences is the taxation of these vehicles. So for traditional, you have pre-tax dollars going into the account, then you have tax deferred growth, and distributions at retirement are taxed at ordinary income. For Roth, you have post-tax dollars going in, tax deferred growth, and then distributions at retirement are tax-free. There's also differences with some phase outs. So for the Roth, the IRS will look at your level of income and they'll decide how much you can contribute to the Roth IRA. So for 2021, if you're married, filed joint, once you reach $208,000 of modified adjusted gross income, you cannot contribute. Now for the traditional IRA, they'll let you contribute with no problem, no matter what your income level is. But if you also contribute to an employer sponsored plan, like a 401k, and you make above a certain amount, then that contribution will not be deductible. And so there's lots of planning strategies when it comes to utilizing these vehicles. You've probably heard backdoor Roth or Roth conversion. And sometimes you may read or hear that everyone should be doing a certain strategy. And it might sound ideal. It might work for you, but it might not, because like I said earlier, it truly depends. You can't apply one financial planning strategy to every client. And we really approach financial planning like we do our portfolio management, with personalization and the client's best interests. So the next one is contribute to a health savings account if you're in a high deductible health plan. And if you're not in one, consider creating a separate medical expense account. So we love HSAs. We think they're great vehicles. We often call them a tax trifecta because you put pre-tax dollars going into the account, a tax deferred growth, and then you take qualified withdrawals whenever you need them for health expenses. It's also cool because it converts into a retirement plan at age 65. So you have no penalty and it's basically treated like an IRA or a 401k, and you're just taxed on the withdrawals at retirement at ordinary income. The next is contribute to education savings if you have children. We typically do recommend the 529 plan. It's another tax advantage plan. Something to note here is that you don't have to do your state plan. Yes, often you get a state tax deduction for doing so, but we also think it's important to evaluate fees and investments of other 529 plans. And there's also certain spending strategies when it comes to these and deciding who should own the account for FAFSA purposes. So then we finish up with establishing savings for short-term or midterm goals, and then continuing to add to retirement education savings. So when I think short midterm, I think like home improvement or going back to school to get a higher paying job. And then finally, any money that's left over is for more discretionary types of goals. So you can think vacation or a new car. So like I said earlier, there may be certain factors that cause you to reprioritize this workflow because it's really not a one size fits all, but hopefully it can serve as a useful checklist for you and a potential strategy for you to reach your financial goals. And if you're interested in learning more in the process of financial planning, or if you're interested in financial plan for yourself, definitely feel free to reach out to me or Andrew. And Andrew is going to go over some resources for you all.
Awesome. Thank you, Melissa. A couple of resources here quickly, and then I see a couple questions we can get to. Morningstar.com. So this is a website. I mentioned the challenge of discerning how much you're paying in fees, specifically on mutual funds, ETFs, any kind of weird financial product that you might have in your portfolio. Morningstar is an independent site. We don't run it. I'm really glad we don't. It's a very useful resource tool. But when you look at your portfolio, you can see what's called a ticker, and it's usually on a mutual fund. A lot of times you're going to see 5 letters, and that's what the mutual fund ticker is. And you can actually type in that ticker on Morningstar, and Morningstar is going to show you 2 things. One, they rate all of their funds, into everybody's funds, not theirs, but everybody's funds in terms of the performance, the track record, stability of the management team, the people actually making decisions inside of that portfolio, and the expenses. And they do it, I don't know if there's any football nerds on the call like myself, but they kind of do it like we would do when we're looking at recruits for college football. So they rate everything between 0 and 5 stars. So a 5-star recruit is somebody that's really, really talented. A 5-star fund means the performance is good, the track record is good long-term, the management team is stable, and the fees are pretty appropriate. So that's really helpful, but you can also just look on Morningstar and just find what's called the expense ratio. That's a great way to figure out what you're paying. And if you don't know how to do that, we can help. But in essence, what you want to do is you want to look at what the expense ratio is and multiply that by the dollars that you have invested in that single position. So that's a great resource. We write a lot on our blog. Topics range from what's going on in the market to personal finance tips. We even do book reviews on there, which is, sometimes gets a little out of control, gets pretty wild there. But narwhalcapital.com/blog. We started doing this a year ago, a little over a year ago. We give daily market and economic commentary live on Zoom. We started it just with clients. It's open to the public though. So you can go to narwhalcapital.com/briefings. We start every day at 8:30. We'll have one tomorrow morning at 8:30. And we're doing it basically every market day. So if there's a stock market holiday or it's a weekend, we're not on there, but you can dial in. You don't have to do anything. You don't have to prep. You can just hop in there. I've also got my contact info right there. Melissa's there as well. You will obviously get that when you get the presentation. With that out of the way, I guess we could jump to Q&A here. So, couple good questions here. Oh, one endorsement. Somebody in the thing says, please join the meeting, our briefings. It's a great 15 minutes start to the day. So, and that was not from me. So thanks for saying that, attendee of this call. First question I've got is, how much does it cost to create a financial portfolio? And is it worth doing for medium income families? The cost piece is a challenge. Really depends on what you have going on there. I'm not trying to be vague here, so I'll give you a couple answers. First is, if you want to do it yourself, it has never been cheaper to manage your own assets than it is right now. There are robo-advisor platforms that can get you started. There are tons of companies that offer free trading. My personal advice is that you avoid Robinhood and some of the apps that aren't really backed by significant capital. There are some risks associated with that, but you can get a free account with Schwab. You can make trades free there. It's a very reputable, large platform. You can do it with Fidelity. You used to be able to do it with TD Ameritrade, but they just got bought by Schwab. There's a lot of platforms you can use and get free trading. So if you want to do it yourself, that's kind of how I would be thinking about it. In terms of cost, if you wanted to hire someone to do it, it's probably going to cost you about 1% of your assets annually. That's kind of the normal rate. That cost tends to go down as your asset grows. But that's kind of how I'd be thinking about cost. Should you do it? The short answer is yes. The longer answer is refer back to what Melissa just walked through. I think when you're thinking about a financial portfolio and what you're setting aside, make sure you're ticking boxes in terms of paying off debt. Make sure you're contributing to your 401k. Make sure you're not hampering your cash flow, meaning the money coming in and the money coming out, just so you can invest in stocks or bonds. I really think having a long-term approach, it's very, very valuable for medium income families, for anybody. The vast majority of Americans get to retirement and they are underfunded for retirement. So the clear answer, if you hear nothing else, is yes, you should do it. But there are some caveats to that. So I'd highly encourage you, if you have questions about how to get started with that, shoot me or Melissa an email. We promise not to sell you anything. We can just kind of talk through the options of what it would look like. Another great question here. Any rules of thumb for appropriate asset allocation? So to step back a little bit, we talked briefly on asset allocation, what it means. The way that we like to talk to people about asset allocation is really through the lens of something that most of our clients know and love. It may not be the case for Amanda's clients, but we try to talk about it through the lens of alcohol. So when you're thinking about how you invest, stocks are really your beer. If you're having a big night out, you're going to want a lot of beer. There's a lot of different ways you can go with beer. You can buy, Coors Light, Miller Lite, Bud Light, kind of those big blue chip, boring American beers, and they're pretty predictable. You can go with international, small, speculative companies and invest in stocks, and maybe that's some kind of weird high gravity foreign import that you've never heard of, but the bottle looks cool. So you can go a lot of different ways, but ultimately stocks are going to kind of be the portion of your portfolio that usually is going to be the majority, at least in the early part of your life, and it's going to be the part that grows. Bonds are your wine. It's for people that think they're classy, they think they're sophisticated. Bonds are a lot like wine, and that you really want to, on a bottle of wine, I don't know anything about wine, but I'm told you want to pay attention to who made it and what the vintage is. The same is true with bonds. You want to be paying attention to who issued the bond. Are they going to be able to pay me back? Do they have a good track record of doing that? And when is it going to mature? Meaning, when am I going to get my money back from that? And so bonds are usually used in portfolios for two reasons. One, to generate income, because they're going to pay you twice a year an agreed upon amount of money into your portfolio that's income. They're also used to limit volatility in your portfolio. So if stocks go up and down a lot, bonds go up and down a lot less. So that's usually kind of how we think about it. You can get into other asset classes, private equity and some direct investing stuff. That's really your liquor. It comes down to what it is. Do you know what it is? Do you know who's giving it to you? You'd never walk up and drink a half-consumed tequila shot at a sketchy bar. You probably don't want to do any kind of direct investing with somebody you don't really know. So there's a lot of ways you can kind of think about the different asset classes. A rule of thumb that's pretty common is that you should have fixed income that matches your age. So the old way of thinking was, if you were 40 years old, you should be 40% fixed income, meaning bonds. In this day and age, It's very hard to find super attractive fixed income. It's a more competitive environment. Interest rates are very, very low. If you're younger, I would cut that in half. So now, if you're 40 and you're wondering how much fixed income should I have, I probably wouldn't say 40%. Maybe you're looking more in that 20 to 25. Again, just kind of a rule of thumb. One thing we try to do here is really customize every portfolio on the allocation side and also the risk side within each allocation. So it's really a tough question to give you a totally complete answer, but you really got to kind of think about that. A couple more questions here. Melissa, question for you. What's the best way to keep track of living expenses?
Awesome question. So I don't know if there's a best way, but it's more about finding a way that works for you. And I think to figure that out, you have to go through a lot of trial and error. There are options like mint.com, personal capital, and then you can do the traditional Excel spreadsheet, or you can just write it out. For me personally, I've tried a few different approaches, especially coming right out of school and into a job with income and some student loans to pay off. I tried mint.com, didn't really work for me. And I think I dabbled with personal capital. But what I found to work for me the best is Excel, because I'm able to customize it to what I need. And I can look at my bank statement every other day or every week and add those expenses to my Excel spreadsheet. I know oftentimes bank companies will send you a statement and they'll have a breakdown, but sometimes those categories don't align to how you want to budget. So I don't know if that completely answers your question, but it's more about finding what works for you. And with that comes trial and error.
Awesome. Thanks, Melissa. Another question here. What are your thoughts on strategies to prepare for an apparent equity bubble? So people get really scared when they think about investing and they think about bubbles, because bubbles are really cool and they look awesome until they pop. My daughter has learned that the hard way with bubble gum. So people like to get out in front of that. For us, our view broadly is first and foremost just a discipline to asset allocation. What you don't want to be in is a position in which you're allocated, call it 60% to stocks, and there's no trimming of stocks. Stocks continue to run up. You get to 65%, 70%, 75%. All of these moves have presented an opportunity for you to take risk off the table, and you haven't done so. That's why I think discipline, whether you're working with an advisor and you're kind of criticizing or judging what they're doing, or whether you're doing it yourself, I think that's why that's really, really important. That's a big part of what I just mentioned, bonds. That's a big part of where that comes in. Really, for the last 10 to 12 years, we've had people saying, why do I own bonds in my portfolio? And the reality is you own bonds in your portfolio to help limit the blow up on the equity side. So if you think about the example I just gave, let's say you were 60% stocks, 40% bonds. If you're constantly trimming stocks and redeploying to bonds as stocks run up, yeah, you're missing out on some of the fun and some of the upside in the short term, but in the long term, you're going to be pretty well protected. A lot of times holding more physical assets, whether it's gold or cash, can be helpful. Right now, we're at an interesting environment in which, broadly speaking, the Fed has been very clear that they're going to try to manage inflation. They're going to try to keep interest rates relatively low, but they're creating some asset price inflation. Right now, I think the challenge for everybody is to not be too emotional. And to recognize that if borrowing remains relatively easy for companies, they are going to continue to invest in themselves and try to generate excess revenue and therefore excess profits. And so you really need to be thinking about not just what valuation on stocks looks like in real time, but what it looks like relative to kind of the economic backdrop of money coming into the system, which has been pretty consistent for a while. So you really, I think just the biggest thing is staying disciplined to your targets and really making sure you have some of that outside exposure. There's interesting data. I need to put it up on the blog maybe in the next week or so. If you go back into the 80s, for years, people wondered why on earth they held bonds. They wondered why they had that. The stock market did so well. Through the 90s, you had a blip in the dot-com pullback, and then it kind of picked back up. But it's really interesting if you look at even having a 60% stock portfolio and a 40% bond portfolio, which is relatively bond heavy during a great economic cycle of decades. If you had that 60-40 portfolio after the financial crisis of 08, you were ahead of the person that had 100% stock exposure. For years, you said, why do I own these bonds? Why do I own these bonds? Why do I own these bonds? And then it paid off. And I think that's a big challenge. That's also a big reason why I would encourage you to be looking at real benchmarks. If you have bond exposure and your allocation is disciplined consistently and you're underperforming the S&P 500, that's not a bad thing. Those bonds are there for a reason, and they're going to, pay dividends in terms of helping out your portfolio in the long term. I think that is it for questions. Amanda, actually, there's one more for you, Amanda.
Yes, I see that. So this is a clarification from an earlier question that I misunderstood. So the question is, do the witnesses to a will, do they have to be available at the time of probate? In other words, do you have to know where they are all along, all over the years? And so the answer is it depends on if your will is done correctly or not. In my presentation, and you can read it when you get it in the email, that self-proving affidavit that you can add to the back of a will, as long as you do that, you do it correctly, it's signed, it has 2 witnesses, and it has a notary, and it's got all there's very, very specific language that has to be in it, and the courts do read every single one, and they make sure, and they have a checklist. Does it say this? Does it say this? Does it say this? As long as your will has that affidavit on it, you do not have to go and find the witnesses to the will in order to probate it. If you don't have that affidavit or it's not done correctly, then yes, you do have to at least try to find the witnesses to the will. A lot of times we can't, they either didn't put their address, they don't work at that law firm anymore, they've passed away, all of that. So there's extra things that you can do if you can't find the witnesses. The will can still be probated. You have to jump through even more hoops after that. So that's a great question. I'm sorry I misunderstood it before, but yeah, I think that's all the questions. I'm so excited that everybody came. I enjoyed it. I learned a ton. So I appreciate Melissa and Andrew, and I appreciate all of y'all coming. I'm going to email out both PowerPoints. If it's not today, then tomorrow. So don't be alarmed if you don't get it. If you don't get it by end of day tomorrow, shoot me an email at amanda@gawtpfirm.com. My email's been in the presentation. And then I'll make sure that you get it, and I'll see if the recording works. It says it's recording. We'll see if I can figure out how to get it out of here. And if anybody wants the recording, also email one of us and let us know. But I appreciate everyone's time and attention. I think that'll do it.
Awesome.
Thanks, everybody.
Thank y'all.